All I wanted from you was get rid of my enemy. You don't get any extra points by being heroic. That feels nice in movies and such, but in real life, I'm not going to reward you for that. Why did you do it when you didn't have to? Same idea here. I mean, why would I reward you for taking a risk that you don't have to? Let's define a concept of reward. We're going to call this excess return to a portfolio. Remember, portfolios can be as simple as single stock. It's defined as uh, expected return over and above the return of risk-free rate, risk-free asset. So we're going to designate that with RF and expected return as expected return of a portfolio. Hence, your excess returns are expected return to portfolio minus risk-free rate. Okay. In terms of risk, we will designate with the Greek letter beta, which is basically Greek equivalent of small case b, sensitivity of the portfolio to systematic risk. At the level of this class, we will assume that there is a single type of systematic risk, and that is the market risk. We will designate this by the expected return to the market portfolio. Which simply means portfolio of everything. All the NVIDIA stocks out there, all the stocks out there, bonds, derivatives, housing, what have you. It's kind of an abstract concept. In practice, we kind of tend to use the returns to the stock indexes like S&P 500, but in theory, it's actually a little bit wider than that. This means reward to a portfolio is a multiple of reward to the market portfolio. So we're going to say expected return to a portfolio minus risk-free rate is equal to beta times expected return to market portfolio minus the risk-free rate. You can think of that reward to market portfolio as excess return to the market portfolio. So how much return do you expect to earn by owning the market portfolio over and above the risk-free rate? And come on. Well, let's copy and paste. It's a little bit easier. This is nice, but how do we even get here? Okay. For this, we're going to go back to an original idea that was developed by Harry Markowitz in 1948 and also discussed by Bill Sharp in early 60s. The theoretical model says that investors care only about reward per unit of risk that is taken. So for any portfolio P, we define the Sharpe ratio and we're going to divide that by beta of that portfolio. Of course, okay. This is essentially our measure of desirability of a portfolio. How much reward do I expect, or how much excess return do I expect relative to the sensitivity to the systematic risk? Example, if tomorrow market tanks 20%, which stock do you think is going to go down more? NVIDIA or Coke? Anyone? Why would Coke down more than NVIDIA? Okay. Anybody? I'm fine with either answer. I just want to think about your reasoning. Because life is not about reading information from Google, thinking about stuff. Yeah, but that's already in the expected return. Think of it this way: if the market tanks 20% tomorrow, that means there's something seriously wrong about the economy, right? If the economy is in that kind of trouble, that means places like Google, Meta, Microsoft, these people are going to experience big drops in business. Who are the main clients of NVIDIA? These kinds of people. Okay. So I would expect that NVIDIA is going to be affected a lot more by negative shocks compared to Coke. Why? First of all, nobody's going to care about their, if you're smart, 50-cent soda pop. I mean, if you buy it from the gas station, you'll pay $1.50. But you could probably, if you go to Costco, you could buy it even at 25 cents a can, right? I'm not going to worry too much about that. Plus, Coke is a company that operates over 200 countries. Uh, so there's a lot of diversification going on. It's a consumer staple. It shouldn't be, but it is. And so it's not going to be affected as much. So I would, in order for me to hold a stock like NVIDIA, it should be promising me a very high reward, expected return. I mean, it has been delivering it. Today, looking at Facebook, about a year ago, I had a post that said NVIDIA just passed $3 trillion. At that time, I think it was the second or third highest valued company. As of today, which is kind of low compared to what it was on Friday or even on Monday. I mean, it's back up now, but